The number that matters right now is not the body count. It is not the diplomatic statement. It is not the missile trajectory. The number is $107. That is where Brent crude went when the market looked at what is happening in Iran and decided the world has a problem it had not fully priced in yet. And for most people watching this unfold on the news, that number feels distant. An oil price is something that happens somewhere else, between people who trade things you never see, in currencies that move in fractions of a cent. But here is what that number actually means in your life right now. In the United States, gasoline is already above $4 a gallon. US crude climbed roughly 51% in a single month. And according to supply projections circulating inside commodity desks, April losses from the region may be roughly double what March already delivered. March alone was enough to move the global energy market into territory that changes the inflation picture for every major economy on the planet. This is not a price spike, it is a mechanism, and once it starts running, it does not stop at the pump. The war is the trigger, the oil market is the weapon, and the target is the cost of everything you buy, every bill you pay, and every interest rate decision that determines what it costs to borrow money. Here is exactly how the mechanism works, not the headline version, the real version. Step 1. Military conflict raises the probability of a supply disruption. It does not have to cause one. The fear is enough. Markets do not wait for physical events. They price possibilities, and they price them the moment a credible threat enters the calculation. Step 2. That supply fear pushes the oil price higher. The market is not responding to barrels that have already stopped moving. It is pricing in barrels that might stop moving next week, next month, or before a diplomatic solution appears. Step 3, higher oil prices immediately lift gasoline and diesel. Diesel is not just what goes into trucks. It is what powers the agricultural machinery that grows the food, the ships that carry the goods, the warehouses that store them, and the last mile delivery that puts them on your doorstep. Step 4, those fuel costs spread through every layer of the economy that moves anything or makes anything. The airline ticket gets more expensive. The delivery surcharge goes up. The food manufacturer absorbs some of the cost and passes the rest to the price tag. The supermarket absorbs some of that and passes the rest to you. Step 5. All of that inflation pressure arrives at the central bank at the worst possible moment, when policymakers are already trying to decide whether the economy needs support, not restraint. There is a useful way to think about what that fifth step means. Imagine a thermostat in a room that is overheating. The natural response is to cool it down. But the thermostat is wired backward, turning it toward cool makes the room hotter. That is what supply-side oil inflation does to monetary policy. The Federal Reserve cannot raise rates aggressively enough to crush energy-driven inflation without also crushing economic growth. It cannot cut rates to stimulate a slowing economy without pouring fuel on the inflation it is trying to suppress. The tool does not fit the problem, and so the tool sits and the problem continues. The academic term for what happens when the trap fully closes is stagflation. High inflation, weak growth, no effective policy response available. The last time this trap closed around the American economy was the 1970s. Understanding why it might be closing again requires understanding one geographical fact that is driving everything you are seeing right now. The Strait of Hormuz is 21 miles wide at its narrowest point. Through those 21 miles flows roughly 20% of the world's traded oil and approximately 17% of global liquefied natural gas. There is no pipeline bypass that handles anything close to that volume. There is no alternative shipping route that does not add weeks of transit time and significant additional cost. For the global energy system, the Strait of Hormuz is not a choke point among many. It is the single irreplaceable point through which a fifth of the world's energy supply passes every day. What that geography means in market terms is that disruption does not have to be total to be catastrophic. The International Energy Agency has documented repeatedly that even a partial restriction of Hormuz throughput produces price reactions far out of proportion to the actual volume temporarily lost. The market does not wait for the barrels to stop moving. It prices the possibility that they might. And once that probability enters the calculation at any meaningful level, it cannot be easily removed. Fear is a faster mover than oil. The insurance market is already registering this. War risk premiums on tankers transiting the Gulf through Lloyd's of London have risen sharply in response to the conflict's escalation. When insurance gets more expensive, the cost passes directly to the cargo. When the cargo is oil, every barrel flowing from the region carries a higher embedded cost before it reaches a refinery, a gas station, or a power plant. That premium does not disappear when the political situation calms slightly. It lingers as long as the risk calculus remains elevated. Here is the figure that most market commentators are not spending enough time on. According to supply projections being circulated in commodity markets, April losses from the region may be roughly double what March already delivered. March moved Brent above $107 and lifted U.S. crude by more than 50%. If April delivers twice the supply stress on top of a market that is already repriced, the ceiling that most analysts were using as their worst-case scenario becomes the floor for the next phase of this story. The weapon was always the price. Not the missile, not the sanctions, the price. The most important thing to understand about an oil shock is that oil does not stay in the barrel. The first-order effect, gasoline above $4 a gallon, is visible and personal. The second-order effects are equally real and considerably harder to trace back to their origin. That invisibility is precisely what makes them dangerous. Diesel first. In the United States, diesel powers approximately 70% of freight movement by road. When diesel prices rise, the cost of moving anything from a manufacturer to a warehouse to a store shelf goes up. The retailer absorbs part of that increase and passes the rest to the price tag. The consumer absorbs the rest. This is not theoretical. The U.S. Department of Agriculture and the Food and Agriculture Organization of the United Nations have both documented the relationship between fuel costs and food price transmission across multiple commodity cycles. The lag between a diesel price spike and a grocery price spike is typically 4 to 12 weeks. Fertilizer follows oil closely through a less obvious channel. The production of ammonia-based fertilizer is one of the most energy-intensive industrial processes in the global economy. Natural gas is the primary feedstock. In a Hormuz disruption scenario, where 17% of global liquefied natural gas also passes through the same strait, natural gas prices rise alongside oil. Fertilizer costs rise within weeks of that. Farm input costs rise within a growing season. Grocery prices follow within 2. Jet fuel tracks the oil price with a short lag, and airlines do not absorb sustained fuel cost increases. They pass them into fares, reduce capacity on marginal routes, or both. Shipping follows the same pattern. The Freightos Baltic Index, which tracks container shipping rates globally, has historically moved in correlation with sustained energy price increases. A prolonged oil shock does not stay in the energy sector. It migrates across the cost structure of everything that gets made, moved, or delivered. Oil doesn't stay in the barrel. It moves through every system it touches, and it arrives in your life without a label. The mechanism has run before. 5 times in the past 50 years, a geopolitical event triggered an oil shock that spread into inflation, paralyzed central banks, and reshaped the cost of ordinary life for years afterward. The pattern is not a theory. It is documented history, and the pattern runs the same way every time. October 1973. The OPEC oil embargo, triggered by the Yom Kippur War, reduced global supply by roughly 5%. The oil price quadrupled within 3 months, from approximately $3 per barrel to $12. United States consumer price inflation rose to 11% by 1974. The Federal Reserve raised rates but moved too slowly and too modestly. Inflation became entrenched. The economy contracted into recession. A 5% supply shortfall produced a crisis that lasted years and introduced an entire generation to the word stagflation. 1979. The Iranian Revolution removed roughly 5% of global supply, the same rough proportion as in 1973, with the same disproportionate effect on prices. Oil doubled inside 12 months. U.S. consumer price inflation hit 13.5% by 1980. Federal Reserve Chair Paul Volcker's response was the most aggressive in the institution's modern history. The federal funds rate rose above 20%. The medicine worked. The side effect was the deepest recession since the Second World War. The trap had closed completely. The only exit was through pain. August 1990. Iraq invaded Kuwait and removed another significant chunk of Gulf supply from the world market. Brent crude rose approximately 75% in the 3 months following the invasion. The Federal Reserve held rates through the spike rather than tightening aggressively, contributing to a brief but real recession. It was the first time since the 1970s that mainstream economic commentary used the word stagflation with genuine concern rather than historical reference. March 2022. Russia's invasion of Ukraine sent Brent crude to $139 per barrel, the highest since 2008. European energy inflation exceeded 20% on an annualized basis within months. The Federal Reserve and the European Central Bank were both caught mid-pivot from a period of extraordinary monetary accommodation. They had spent 2 years providing near-zero rates and balance sheet expansion to support pandemic-era economies. The oil shock arrived just as they were trying to reverse course. The result was the fastest rate hiking cycle in 4 decades. Mortgage costs doubled in many markets. Housing activity froze. Inflation in core goods categories persisted well beyond the initial energy price spike. And now, April 2026. Brent, above 107. U.S. crude up roughly 51% in a single month. April supply projections suggesting disruption may be twice as severe as March. The Federal Reserve already delaying rate cuts that it had been signaling. The questions being asked in commodity markets and central bank research departments right now are not new questions. They are the same questions that were asked in 1973, 1979, 1990, and 2022. The mechanism is not new. What changes each time is only who is holding the trigger. Here is the arithmetic that makes this more than just an inconvenient commodity price. The Federal Reserve's primary mandate is price stability, defined as inflation near 2% on the Personal Consumption Expenditures Index. When inflation rises above that target, the standard response is to raise the federal funds rate to increase the cost of borrowing, suppress consumer demand, and cool the economy until prices stabilize. That framework works reasonably well when inflation is driven by excess demand. People are spending too much. Companies are charging too much. Wages are rising faster than productivity. Tighten credit, slow the economy, and prices eventually respond. Oil-driven inflation does not respond to that logic, and this is the part that most commentary glosses over. Raising the federal funds rate does not increase the number of barrels flowing through the Strait of Hormuz. It does not reduce the war risk premium that insurance markets are pricing onto Gulf tankers. It does not lower the cost of diesel for the trucking company trying to move goods from a warehouse to a store. What it does is raise the cost of every variable rate mortgage, every business credit line, every auto loan, and every small business operating with borrowed capital. It slows economic activity. It does not fix the supply problem that is driving the inflation. So the Federal Reserve is left with a decision that is not a real decision. Raise rates, and you worsen the economic slowdown without solving the inflation because the inflation is not coming from the demand side. Cut rates, and you stimulate an economy that is already generating inflation pressure, potentially adding momentum to an inflationary spiral. You cannot stop with the same tool you used to start it. The Federal Open Market Committee's recent meeting minutes show a recurring and unresolved debate over exactly this problem. Whether the supply-side character of the current inflationary pressure changes what the appropriate policy response looks like. The International Monetary Fund flagged stagflation risk explicitly in its most recent World Economic Outlook. The Bank for International Settlements published research within the past 2 years, documenting that oil-driven cost-push inflation tends to persist into the broader price index for 12 to 18 months after the initial shock, even when the oil price itself stabilizes or retreats. The spread is the problem. Once oil inflation bleeds into services, into wages, into long-term supply contracts, it becomes self-sustaining in ways that the original commodity price move does not predict. The mechanism is designed to produce exactly this outcome. The central bank is not failing, it is trapped. The obvious counter-argument is worth taking seriously for a moment before taking apart. Higher oil prices hurt everyone equally, the argument goes. Producing nations, transit nations, consuming nations, a disrupted global energy market is bad for all parties. The mechanism that has been described here punishes broadly and without discrimination. This is only partially true. Saudi Arabia's fiscal break-even oil price, the level at which the kingdom's government budget balances, sits in the range of $70 to $80 per barrel across most recent assessments. At $107, the Saudi government is generating a windfall surplus. Saudi Aramco's financial results during previous oil price spikes document the pattern clearly. Elevated prices produce earnings that fund the social spending, infrastructure investment, and subsidy programs that sustain the political stability of the Gulf states. The broader Gulf Cooperation Council economies benefit from the same dynamic. A war that disrupts the Strait may not be their preferred outcome, But the elevated price environment that surrounds the disruption risk is not unwelcome to their finance ministries. U.S. shale producers operate with higher per barrel extraction costs than Gulf producers, but generate strong margins at any sustained price above roughly $60 to $70 per barrel. A price sustained above $100 is a significant windfall for the Permian Basin, the Bakken, and every other major U.S. producing region. The companies that managed debt carefully through the lower price environment of the early part of this decade are now reporting earnings that allow them to reduce leverage, return capital to shareholders, and accelerate production plans. Here is why that matters for understanding how this situation resolves. The parties who benefit most from the elevated price have less structural incentive to push for a rapid resolution of the geopolitical pressure sustaining it. That is not a conspiracy. It is an incentive structure. And incentive structures shape outcomes more reliably than stated intentions. 4 things to watch in order of importance. Brent crude above $110 per barrel is the threshold that historically begins to affect corporate earnings guidance across non-energy sectors in a meaningful and visible way. Below that level, the shock is absorbed and passed through in ways that take time to appear in reported results. Above it, the cost pressure begins to appear in earnings misses, downward forward guidance revisions, and margin compression in industries that depend on energy-intensive inputs. If Brent holds above $110 for more than 6 consecutive weeks, history suggests the inflation spread into services and manufactured goods becomes significantly harder to reverse in a short period. Hormuz is the binary signal. Any confirmed report of a physical closure, even temporary, even partial, produces an oil market reaction that no gradual escalation can replicate. A 72-hour disruption of meaningful throughput qualifies as a global supply emergency under the International Energy Agency's own classification criteria. Watch the Lloyd's of London War Risk Premium data. As a leading indicator, it tends to price the probability of physical disruption before the disruption occurs, making it more useful than headlines as an early warning signal. Federal Reserve language is the 3rd signal to track. Watch for the shift from patient or data-dependent framing toward language that acknowledges elevated uncertainty around the inflation trajectory or any explicit acknowledgement that energy prices are complicating the rate path. The dot plot, the Federal Open Market Committee's summary of economic projections, is the clearest numerical expression of this shift. A move in the median projection for the first rate cut from earlier in the year to later in the year, or from this year to next, is the market's clearest confirmation that the mechanism has changed the monetary timeline. The 4th signal is the spread between headline CPI and core CPI in the monthly Bureau of Labor Statistics release. When that spread widens headline, running 2 or more percentage points above core, it is evidence that oil-driven inflation is no longer contained to the energy category. It has spread into the broader index. That is the moment the mechanism has fully engaged and the secondary effects are no longer theoretical. Watch these 4. The war is the headline. The mechanism is what matters. When you see a conflict on the news and you think about oil prices, the instinct is to treat them as separate things. The war is a geopolitical event, serious and distant. The oil price is a market reaction, technical and temporary. The spike will come and then it will settle. The market will find new supply. The situation will stabilize. It always does. Sometimes it does. And sometimes the mechanism runs all the way. 1973, 1979, 2022, and now 2026, all share is not the geopolitical event. Each of those crises was different in its geography, its actors, its stated causes, and its specific military or diplomatic character. What they share is the mechanism. War risk enters the oil market. The oil market encodes that risk into a price. The price leaves the barrel and moves through diesel, through fertilizer, through jet fuel, through shipping rates, through the cost of producing almost everything that gets produced. It arrives at the central bank as an inflation number and finds the standard tools do not fit the problem. The economy slows. The inflation persists. The conflict in Iran is not fundamentally an oil story in the narrow sense of that phrase. It is an inflation story. It is a cost of living story. It is a monetary policy story. It is a story about how power and energy and money are connected through systems that most people never see but live inside every day. $107 per barrel of Brent crude is not a commodity data point on a trading screen. It is the mechanism announcing its presence, The trigger was a war, the weapon was the price. And the target, as it always is when this mechanism runs, was never a government or a military installation or a diplomatic relationship. The target was the purchasing power of ordinary people trying to fill a tank, pay a bill, buy food, and borrow money to build a life. The mechanism does not care who started the war. It runs the same way every time. Before we move on, a few principles for thinking about what this mechanism means for your own financial position. This is not investment advice. I am not a financial advisor. What follows is a framework grounded in documented history, a way of thinking more clearly about something that is already affecting your purchasing power and will continue to do so, regardless of how the geopolitical situation resolves. The first principle is that energy price inflation is stickier than it appears on arrival. The Bank for International Settlements published research within the past 2 years, documenting that oil-driven cost-push inflation tends to persist into the broader economy for 12 to 18 months after the initial price shock, even when the oil price itself stabilizes or retreats. The reason is transmission lag. The oil price moves in hours. The freight cost adjustments, the food price revisions, the services repricing, and the wage responses follow in quarters. The gasoline price you see today is not the final accounting. The full spread into household budgets lags considerably behind the headline barrel number. The second principle is that oil shocks do not affect all households equally, and the channel that matters most depends on your own cost structure. Lower-income households spend a higher proportion of income on energy, food, and transportation, the primary first-wave transmission channels. Middle-income households with variable-rate debt face the squeeze most acutely in the interest rate channel. If sustained oil-driven inflation prevents the Federal Reserve from cutting rates, the refinancing opportunity that many mortgage holders and borrowers were waiting for moves further into the future. Understanding which channel represents your largest exposure is the starting point for thinking clearly about your own situation. The third principle is that the historical record of commodity-linked assets, real assets, and inflation-protected instruments during sustained oil shock episodes shows consistent relative behavior patterns compared to nominal bonds and cash. The IMF's research on portfolio performance during the 1973, 1979, and 2022 episodes documents these patterns in detail. Whether those historical patterns apply to your specific circumstances depends on factors that no general script can assess. The data is the starting point, not the conclusion. The mechanism is running. The question worth sitting with is not what the oil price does next week. It is how far down the transmission chain the effects reach before the pressure finally releases, and whether your own financial position sits upstream or downstream of the channels that carry the most force.